Hello everyone, welcome to the video. So we're going to be summarizing why inflation has been so high, and we'll also review rate hikes by the Fed and how they affect the average person. So first of all, let's go ahead and define inflation. Simply put, it is the decrease in purchasing power of money. Here's an easy way to put that. Our inflation rate in 2021 was a whopping 7%. If your $1 was worth 100 cents, now it's the equivalency of basically only being worth 93 cents. So every time inflation happens, your dollar is devalued. That normally happens at a rate of only 2.5% each year, but in 2021, it was 7%, which by the way is the highest it's been in 38 years. Now let's get to the basic definition of what causes inflation. Remember, it's a decrease in your purchasing power with your money, but why would that happen? Well, it's because inflation is due to an increase in prices of goods and services. So inflation happens when the price of things we buy and services we pay for goes way up. So let's review what caused this increase on prices of goods and services. The first thing we need to review that caused inflation is supply and demand. Now, unfortunately, the pandemic caused a perfect storm for this to happen. Remember, we said inflation happens when prices of goods and services go up. And when you're talking supply and demand, if there is way more demand for products and services than there is supply, that forces prices to go up. That's basic economics. On the flip side, if there's way more supply than demand, for example, if there's way more houses than there is buyers, and that's an example of the supply being higher than the demand. Now, obviously, we know that's not happening for the housing market. There's actually way more demand than there is supply. So the pandemic created this perfect storm for supply and demand, for demand to be way higher, which forces prices to go way up on goods and services, which is the definition of inflation. But why did this happen because of the pandemic? Well, a few things actually caused this. One, we had supply chain issues for companies. This meant that they already couldn't get as much of their supply because of what was going on with the pandemic. Now, to make things worse, at the time, the Fed did not want the economy to collapse. So what did they do? They lowered interest rates to all-time lows. And what did that do? That caused people to want to borrow more money. They wanted to take advantage of these lower interest rates to buy houses, to buy cars, at as low of an interest rate as they could. All of that obviously increased demand in those sectors as well. But get ready for the nail in the coffin. And it's something we all already know. On top of everything I just said was supply issues that companies had, and it being way cheaper to borrow money than it ever has been, the Fed also pumped trillions of dollars of money into the economy to keep it afloat. The way everyone best remembers this is in the form of stimulus. A bunch of people got several stimulus payments sent to them. So on top of a supply chain issue where companies didn't have enough goods for people to buy, and interest rates being at an all-time low, which made it easier to borrow money, which made it easier to buy, and people having access to a bunch of money that they did not have before, you had an insane amount of people buying goods and services, an insane amount of demand, but not enough supply, which forces prices of goods and services to go up, which raises inflation. However, there's one more thing that also raised inflation, especially in 2021, and this was the labor shortage. Companies could not keep anyone working. This meant that to entice anyone to work, companies had to increase their wages. And when companies have to increase wages, they don't just accept that loss, they pass the cost on to consumers. They pass those costs on to the likes of you and me. So now it's more expensive to buy a loaf of bread. It's more expensive to buy a gallon of milk. So the cost of goods and services went up because companies have to pay people more money to work, and the companies pass those costs off to us, which again raised the price of goods and services, which raised inflation again. So that's why inflation went up so much in 2021. You had a labor shortage, and you had a supply and demand issue. Now that we know why inflation ran so rampant in 2021, let's talk about what rate hikes are. Basically, the Fed raises interest rates so that it becomes more expensive to borrow money. This means higher interest rates for mortgages to buy houses, higher interest rates on auto loans, higher interest rates on credit cards, higher interest rates on any debt. So why would the Fed do this? Why would they do a rate hike? Why would they intentionally increase interest rates? It seems like that would not be good for the economy, right? Well, that's the point. When inflation gets out of control, the Fed's only way to combat that inflation is to literally intentionally try to slow down the economy. They raise interest rates on purpose in hopes to slow the economy down and hopefully control inflation. Remember, if you can slow down demand, then suddenly supply will start to even out and eventually outweigh the demand. This puts inflation in check. However, it's basically an intentional sabotage of the economy. So how do these rate hikes by the Fed and rising interest rates affect your average consumer? How does it affect the average person like you and me? Simple. For your average person, I already explained it. You'll see rises in interest rates for mortgages, auto loans, credit cards, debt. Pretty much any way in which you would borrow money, you will see interest rates go up. However, there's another group of people that this affects, and it's those who invest in the stock market. Historically speaking, when the Feds do rate hikes and intentionally increase interest rates, that tends to lower inflation. However, if you look at a chart, you'll notice that when that inflation goes down, basically almost every time, the stock market drops. So this intentional sabotage of the economy to slow down inflation also slows down the stock market. So obviously, when the Fed is talking big rate hikes that they want to do to put inflation in its place, anyone who's invested in the stock market gets a little scared because, historically speaking, that means the stock market is going to go down as well. Just to point out a couple examples on the chart here, in the year 1980, inflation went way down, and the stock market went down as well. The same thing happened in the year 1987, and who could forget the year 2008, where inflation went way down, the stock market also went down. So pretty much any time in US history where inflation went down, the stock market also went with it. Which makes sense because if the Fed is intentionally sabotaging the economy, in theory, that's also going to slow down the stock market because the stock market does well when the economy does well. So if the economy is slowed down, the stock market will also slow down. Okay, so I hope in this video I was able to help summarize what inflation is, why inflation has been on the rise, what rate hikes are from the Fed, and how that affects you as the consumer. If you enjoyed the video, make sure you give the channel a sub and the video a thumbs up. Okay everyone, I hope you have a great day.